Hey, it's Jim, and this is level 1 of the CFA program, topic on financial statement analysis, and the learning module on analyzing cash flow statements, part 2. You should recall that in part 1, we put our accounting thinking caps on, and we looked at historical data to determine how much cash was generated from operating activities, from investing activities, and from financing activities. Here in part 2, we're going to continue to think like an accountant, but we're also going to put our financial analyst cap on, and we're going to use this historical data as a basis to estimate future cash flows. In fact, one of the first sentences in this learning module, and I'm paraphrasing here, says something like, a good financial analyst is able to forecast and estimate future cash flows. So that's kind of what we're going to be doing here. As you look at the learning outcome statements, you might breathe a sigh of relief. Wow, it's only 2. That first one here is really a combination of what we did in part 1 plus the common size stuff we did for the balance sheet and the income statement. So that first part, that first LOS should be a little bit of a review. I think the more important of the two, and which would be, if I were creating questions for the exam, my emphasis would be on calculating and interpreting what we're going to call free cash flow. Now, we've done operating cash flow in the past. We're going to do free cash flow here, and then we're going to do some ratios. You know, I say this to you regularly, and you know this. You have to memorize a whole bunch of formulas. Lots and lots of ratios out there. You might as well start memorizing them now because you're going to need them in level 2 and level 3. That way, if you memorize them, they become a permanent part of back here in the back right part of your brain. Of course, I made that part up. I don't know where it sits in your brain. Maybe at the back right, maybe the back left, wherever it is, as long as you have it in your toolbox for the exams. So let's go ahead and quickly continue to think like an accountant. So we've got 2 kind of sets of financial statements, the reported financial statements, which you can just see on your phone very, very quickly, the annual report and the quarterly reports from any company that's out there. What is the focus here on those reported financial statements? Well, we've already done one on the balance sheet. We've done one on the income statement. Now we're doing cash flow. So look at that last arrow point down there under reported. How the company manages its cash flow, and then, of course, how that cash flow relates to liquidity, its ability to meet both short-term and long-term obligations. And then you shouldn't be surprised that we're going to have a section on common-sized cash flow statements. Let me just re-emphasize what I told you in those previous recordings. We're doing this for multiple reasons, but primarily we want to look at the trend. Let's go back 3 years or maybe 5 years. You probably don't want to go back 50 years, but there might be something helpful in there. But you want to do the trend analysis, you know, what this ratio is going to be, what are the accounts going to be, what are the common size percentages going to be over time, so that we can identify the source of that change. And then we don't live in a vacuum, so of course we want to compare it to our neighbors. And the Institute is not going to call it the neighbors on the exam. They'll call it the peer companies. And what that common size stuff does is it just takes size out of the equation. You might recall that there were 11 good questions in part 1. There are only 4 questions at the end of part 2 here, and here's one of them. In fact, those 4 questions are relatively straightforward. In fact, you might not even need to listen to me over the next 30 minutes or so to go answer those 4 questions. However, remember that the Institute says any LOS is a fair target for a question on the exam. All right, so what did I say just a minute ago? Yeah, our focus is on evaluating the major sources and uses for what we did in part 1, operating, investing, and financing cash flow. So let's go ahead and take a look at these in a little bit more detail. Now, what the Institute does in this section of the learning module is say something like, look, we're going to focus on this cash flow depending on what stage of growth the firm is currently in. Now, I can't remember if we've done this so far in level 1, but you'll get this 100 times by the time we get to the end of level 3. And this is not the Institute. These are accounting professors and finance professors and economics professors. There's a graph out there that, here, I'll just draw it for you. You know, you go down for a little bit and then you go back up and then maybe you go down a little bit. It's called a J-curve, you know, maybe called some other kinds of things. But this is appropriate here to decide where the firm is. A high growth company would be down here, you know, going up and up and up. And then a mature company is one up here. My advice is to think of, and here, let me show you this next slide. So here we have a mature company, then we'll have a new or a high growth stage company. I want you to think of these mature companies as those that have brand names, right? Think of Milton Hershey, right? What does Milton Hershey do? Every day he wakes up in the middle of Pennsylvania and he makes chocolate bars and Hershey Kisses, which means that he's been doing this for 1,000 years. He's probably going to be doing it for another 1,000 years, which means that if you look up at that step one, you know, the sources of operating cash flow for a mature company is very, very likely to be its operations. That makes perfect sense. What's the goal of the business? Maximize shareholder wealth. One way we do that is by making something for pennies and selling it for dollars. The accountants call that a margin. And so what are we looking for here? Mature companies, we're looking for persistent operating cash flows because of those brand names. Now, what the Institute also wants us to be able to do is to find those scenarios that are maybe outliers. What happens if we have a mature company that has negative operating cash flows? And if they are persistent, well, this is no good. That must mean that their product line is no longer a brand name, or that brand is suffering from a variety of external forces. Maybe it's just competition, or maybe it's government regulation, or whatever it could be. But remember that if we have persistent negative operating cash flows, we're going to have to go to the outside world for financing. And the Institute and finance professors call this external financing. Now, we're going to have great conversations about capital structure and positive net present values sometime in the future. But essentially what's happening here is that we're going to borrow money to invest in long-term assets, and those long-term assets are going to pay off. Then we're going to be able to repay, you know, the bondholders in their interest payment, or the shareholders and their dividend payments. So those two embedded bullet points are probably important. Now, those cash flows from operating activities, and let me give you my definition. I did this before, but I'm going to repeat myself. Operating cash flow is the amount of cash remaining after all expenses have been paid. You know, so suppose a firm has $100 in operating cash flow. That means that it doesn't owe anybody any money, whether it's in the short term or the intermediate term or the long term, right? It's paid all of its bills. So what can it do with that? Well, it can invest it back into the corporation. It can take those and invest those cash flows and invest in positive net present value projects. Now, at this stage, what we're doing is calling those profitable investment opportunities. Now, look at the next and the last bullet point there. And this is a very hot topic with politicians over the last decade, maybe even longer than that. When firms have lots and lots of positive operating cash flows, and they've invested in positive net present value projects like a building or a piece of equipment or machinery, and it still has some leftover cash, what it can do is it can repurchase its bonds or repurchase its shares of stock. And there are certain politicians out there who really, really don't like that idea, but that's not a conversation for this LOS. So focus on the mature and the brand name and all that kind of good stuff here. However, and here's this little J curve, you know, we're down here at the bottom before we can move upward, and maybe we're starting to move upward. Well, of course, that must mean that they're not making something for pennies and selling it for dollars. They're making it for dollars and selling it for pennies because the product line is not well known. So we may have negative operating cash flow initially, and that probably means that, you know, we've got a bunch of short-term assets there. We don't have cash, but we've got inventory and we have receivables, so we're going to try to turn those things over. Remember those turnover ratios that we talked about in a previous recording, so that sooner or later we're going to generate a positive operating cash flow. So I think what the Institute is focusing on here is twofold. The sources of that cash flow, so there's that bullet point down at the bottom, and then what happens if operating cash flow is negative for a new or a high growth or early growth stage company, and then back here for a mature company. Now, a couple of other things here before we move on. We need to worry about working capital. So that's why down here at the bottom, we ask the question, what is the main sources, and are those cash flows positive and sufficient to cover those capital expenditures? Keeping in mind that here with this new or relatively low growth initial company, lots of investment in inventory and receivables. So now we're going to call this working capital management, these working capital accounts. So of course, what do we want to do? We want to turn those receivables into cash. We want to turn those inventories into cash, and we want to make our payables. We want to pay those at the latest possible time. Now, there's a paragraph in this learning module in which the Institute is emphasizing the difference between net income and operating cash flow. Remember now that net income is massageable, right? The accountants can get their hands on the revenues and the expenses, and they can pick and choose depreciation methods, inventory valuation methods, all sorts of stuff in there so that they can make the net income look as beautiful as possible. Operating cash flow is less massageable, so it's probably better to use operating cash flow to assess that earnings quality for that reason. Now, recall that with operating cash flow, we need to worry about those non-cash expenses like, well, we mentioned depreciation here, but don't forget amortization. And I always tell my students, don't forget depletion. And I'm always fascinated by, the Institute and textbooks. A lot of times they just forget about depletion. Now, of course, depletion applies only to firms, mostly in the energy business or the mining business. But still, depletion is important. And I wouldn't put it past the Institute to throw depletion on there because, we talk about it in some other kinds of learning modules. So look at the last one here. This is an important sentence. High net income, poor operating cash flow indicate poor earnings quality. Now remember back in one of those earlier modules when we talked about means and standard deviations, and remember that standard deviation is a measure of risk. If we have a random variable that has high standard deviation, that means it has high risk. If we have a random variable that has zero standard deviation, well then it's not a random variable and it has zero risk. So what we can do is we can go ahead. Now, what did we say earlier on one of those slides? Let's take a look at the trend. What we can do in the trend is we can calculate the mean. That's probably a little important, but we can also calculate the standard deviation. And so we can observe that variability. High standard deviations means lots and lots of risk. What we need to do then is we need to consider that level of standard deviation of the operating cash flows to forecast future performance. Let me give you just a quick example. What do you think? What do you think the standard deviation of the Hershey chocolate bar product line is? Now, I'm not going to say it's zero, but it's very, very low because Milton Hershey knows that if he makes 10,000 chocolate bars today, he's going to sell 10,000 chocolate bars today because that's what we do. We eat the Milton Hershey chocolate bars. We know exactly how many we eat every week or every month or every year, and Milton Hershey knows that. So standard deviation is probably relatively low. So getting back to that maturity firms that have branded product lines have much more easily predicted future performance based on, kind of internal factors. Now, of course, as good financial analysts, we need to consider the external factors as well. Things like tax rates, things like political influence, things like, investor and consumer preferences. I mean, suppose that we wake up tomorrow and the U.S. Surgeon General says, you know what, if you eat one chocolate bar a day, your hair is going to turn green or something silly like that. Well, that's an external event that would impact those operating cash flows. That's something called operational risk that we'll talk about some other day. All right, so how do we summarize these operating cash flows? Key factors, how's it compare to net income, and are they stable? So that stability relates back to the standard deviation that I was referring to. All right, so let's move to this next step, the investing cash flow. So what are we going to do with some of our cash flow? We're going to invest in long-term assets, property, plant, and equipment. There's that dull word. Think about those metal stamping machines for Harley Davidson. I talked about that before. And then the second one is to acquire companies. So I want you to think about the investing cash flow determinants as the left-hand side of the balance sheet. What do we want to do? We want to buy long-term assets, and some of those assets may exist in other companies. What can we do? We can also sell our long-term assets. So here's the thing. In the light green box there, these are good uses of cash, right? What we're doing is investing in a piece of machinery that's going to generate cash flows next year and in 5 years, next decade and 2 decades and 3 decades, right? The goal is to develop brand name product lines. But what we can also do is we can sell some of those assets. Now, I use this example regularly. Go back 2 decades. Procter & Gamble got out of the food business. So it sold its Jiffy peanut butter product line. It sold its Crisco oil. Well, at first glance, you might think, geez, why is it selling that? Everyone buys peanut butter and they use oil for cooking. But what it wanted to do is focus on its core businesses. Over time, what that means is there's going to be more and more operating cash flow. Now, the problem then is, why are we selling these assets? If we're selling them as part of this strategic plan, then this is probably good news. If we're selling them because the brand name product line inside of those assets is no longer brand name or is losing its luster, well, then that's probably bad news. Now let's switch over to the right hand. So what did we do? We just did left-hand side of the balance sheet. Let's switch over to the right-hand side of the balance sheet, and let's call this capital structure. So what do firms do? Firms, I say this to you guys all the time. Firms, they issue bonds all the time. They issue shares of stock all the time. So bondholders and shareholders are sources of capital, sources of cash. We call that the proceeds of a bond issue, the proceeds of a stock issue. And then what do we have to do? If we borrow money from people on the right-hand side of the balance sheet, they're not going to let us have the money for free. So we need to pay the bondholders interest. We need to return the principal amount to the bondholders. We need to pay the shareholders a dividend payment, maybe not today, but sometime in the future. Shareholders, they kind of implicitly expect the dividend. It might not be for 10 years, but they kind of implicitly expect that. And then we can, what did I say earlier? Those share repurchases, which are not popular with some politicians. So I want you to think about what we just did here in this first part of this learning module is we looked at the income statement. That was operating cash flow. We looked at the left-hand side of the balance sheet. That was investing cash flow. We looked at the right-hand side of the balance sheet, and that's financing cash flow. And I think if you break them down to those 2 financial statements and relate them to cash, you should do fine. Let's move on to the common size cash flow statements. There are 2 ways that we can do this. We can do it as a percent of total cash flows. We can do it as a percent of net revenue. And by the way, one of the 4 questions at the end of this learning module is exactly this slide right here. So let's go ahead and look at an example here. I don't imagine, and of course, if you look at the LOS, analyze and interpret, you won't have to take this cash flow statement here and convert it into this common size, but you'll have to analyze and interpret, which means, and my advice, when you get this, you'd have to get this table on the exam. So go ahead and look at the amounts right there in that middle column. And I would just kind of casually look at those, so you got total inflows of 25, total outflows of 26. So we want to ask ourselves the question, why is one greater than the other? And then look at the column over on the right, and this is the common size stuff. So clearly Sale of equipment less than 1%. So that's just a minor issue for those inflows. But what about those outflows? Oh, payment to suppliers. So that's the top right of the balance sheet, right? How much do we pay our employees? How much do we pay? Look at the purchase of equipment down there. So that's the investment in positive NPV or profitable projects. Boy, that's a focus for me because that tells us what future growth is going to be. So when we do the trend analysis, I would be interested to see, what's that number, 384, if over, let's say, a 5-year period, that thing trended downwards or trended upwards. That tells us a lot about the company's strategic plan. Also of interest there is the last one, dividend payments. How much are we returning to shareholders? We want to keep track of that over time. Now, the second approach, and there's net revenues up at the top, 25, we can go ahead and calculate each of these accounts as a percent of that net revenue. And so, of course, look, the net income, that's, what is that, about half depreciation there. But look down at the bottom, so net cash provided by operating activities, there's 17%. And then we've got a lot of these working capital accounts or accounts that are on the top side of the balance sheet. And then we've got the investing and the financing activities. So these are pretty straightforward kinds of things. My advice is just to go ahead and ask yourself the question, what does this really mean on that right-hand side? What does that percent tell us? The trend and comparing it against our neighbors. So here's a good summary here. Why do we do this? Standardization, we did that. Trend analysis and efficiency analysis. So let's do a couple of just quick examples here. Suppose we've got, here, let me go back here real quick. So we're going to do standardization, trend, and efficiency. And we're just going to take simple examples here. So go ahead and look at net cash from operations. So what is that? We're comparing company A to company B. So clearly company B is massive compared to company A. But if you do this common size analysis, what are we doing comparing against our neighbors? Then you see that, hey, my gosh, company A, company B, 20%. They allocate the identical percentages of their operating cash flows to equipment. Here's this trend analysis. So net cash from operations, what is that? 500 to 550, what is that? 10%. And then, maybe a little bit less than 10%. Purchase of equipment, what is that? 20%, and then 20% or so. But now what we can do is we can see the trend of that ratio up there. There's an increase in the proportion of cash spent on equipment. And then efficiency, let's go ahead and look at net cash from operations. So $1 million to $1.1 million, so that's 10%. But research and development, $1 million to $330, boy, that's over 30%. And so what is this efficiency here? There's a substantial increase from 2022 to 2023 in terms of a percent, 20% increase. Now, here's what I think is the more important of the two LOSs. And so I'm hoping you get what I was saying earlier on, that what we just did is a little bit of a review of part one. Then we took some cash stuff. So you should be good on that. Here are some extra formulas that you're going to have to remember. So I'm going to go ahead and start with this. Let me give you that definition of operating cash flow that I did just a minute ago. It's the amount of cash remaining after all expenses have been paid. Then we introduce this concept of free cash flow. Now, here's my general definition. I think this is really important to remember. Free cash flow is, you ready for this? The amount of cash remaining after all expenses have been paid and all investments have been made. So free cash flow, it's not really free. What it means is that it's the operating cash flow, and then what did you do with that operating cash flow? So let me repeat that. It's the amount of cash remaining after all expenses have been paid, which is operating cash flow, and all investments have been made. So when you're left with free cash flow, I want you to think about it as the following scenario. Suppose you hit the lottery for $1 trillion. How much of that could you spend? Well, you could spend a bunch, right? You're going to buy a PlayStation game, and you're going to buy a house, another car, and whatever it is, a vacation home, and maybe you'll buy a piece of land on the moon. I think you can do that now. But you're going to have money left over, and you're not going to have anything to do with it. That's free cash flow. Now, the important thing, and this links to lots of stuff we do throughout the CFA program, is that when a firm generates lots and lots of free cash flow, this is great news. However, it also leads to two inefficiencies. It leads to the executive leadership team wasting that money. And what wasting that money means is they're tending to consume excess perks, bonuses and salaries and country club memberships. And then they take over other companies that they have no business taking over. So free cash flow, goal of the business is to generate lots of free cash flow. But like everything, there's a cost to generating lots of free cash flow. That's why we have the board of directors who monitor the executive leadership team to make sure that they're not excessively consuming perks and salaries and bonuses, and they approve of all the merger activities. All right, so there are two measures of free cash flow. I gave you the general measure, but two of them that the Institute is very likely to ask you about. Free cash flow to the firm. So think about this. How much cash flow are we generating that is relevant to bondholders and shareholders on the right-hand side of the balance sheet? Free cash flow to the firm. Think of the fundamental accounting equation, assets equals liabilities plus equity. So what are the components? Net income, non-cash. So there's depreciation and amortization. You know what I ought to do? I ought to type in depletion in there just so you guys don't forget it. So one of you will thank me when there's a depletion example question on one of your level 3 exams. Interest cost, capital expenditures, and then working capital expenditures. So think about this. I'm going to augment my definition from just a minute ago. It's the amount of cash remaining after all expenses have been paid and all short-term investments have been made. There's working capital. And all long-term investments have been made. There's the capital expenditures. And then, of course, you need to consider the interest expense and depreciation and amortization and depletion. Yeah, look at the interpretation. So what does the LOS calculate and interpret? So I'll show you how to calculate that in just a second, right? Positive free cash flow to the firm, producing more cash than it uses. This is good news, right? Negative free cash flow to the firm. Now, you might think that this is bad news, but lots and lots of mature firms with brand names have negative free cash flow to the firm. All that means is that they're investing tons and tons of capital in profitable investment opportunities. And what they did is they asked the bondholders and the shareholders for capital. They issued bonds and they issued shares of stock. Now, notice the last two words down there on the bottom right. It might signify heavy investments, which is what I just described, or it might signal that things are not as good as we think they are. All right, here's a couple of key formulas for free cash flow to the firm. So think about what I said. It's the amount of cash available after all expenses have been paid. So there's the net income. And then all short-term investments have been made. So there we subtract out working capital expenditures. And all long-term investments have been made. There we subtract out capital expenditures. And then you can't forget to add back in depreciation and amortization and depletion. And then you got to figure out the after-tax cost of issuing a bond. Let's work through just a quick example here. We've got net income. There's a non-cash charge, interest expense, capital expenditures, tax rate, change in working capital. So there we go. We're just going to go back and use our formula right there. And you can pause the video if you want to verify that we get $251,000 for free cash flow to the firm. Another quick example, cash flow from operating activities. What did I say earlier? This is why I gave you that. So there's a summation of what we did. So interest expense, so there we go. We get the 301. So go back down here. Let me go back here. So look down at the bottom, there's the tip, net income plus non-cash minus working capital management, right? There's the cash flow from operations. So look at that second one, after the or, there's the cash flow from operating activities. So there's that second one where we did example 2. Now, how about free cash flow to equity? So what we're doing is we're just dividing up that general free cash flow equation and model that I gave you earlier. And now we're saying something like, what's available to the common shareholders? What's the goal of the business? Maximize shareholder wealth, right? So free cash flow to equity is a measure of free cash flow that is available to the bottom right-hand side of the balance sheet. So what are we going to do? We're just going to take cash flow from operating activities, which we just did, minus the long-term expenditures, and then plus or minus whether we issue a bond or repay the bondholders, or whether we issue shares of stock or repay the shareholders. Here's a quick example here. What is the free cash flow to equity? So we've got beginning borrowing, ending borrowing, which means we borrowed 50. Cash flow from operations, fixed capital. So there we go. So 450 gets us free cash flow to equity. Let's do this last part here. Coverage cash flow ratios. What did I say just a few moments ago? You're going to have to memorize 1 million ratios. Let's go ahead and sear those into our brain now so that when we get to level 3 and there's a question about an institutional investor, and that institutional investor asks for your advice of whether or not to invest in Hershey Hershey Company, and you say, wait a minute, I know all these equations. So go ahead and do this. And my advice is to get your camera out, take a picture of these ratios. And at this point, after we've done the income statement, after we've done the balance sheet, now we're doing, we did part 1, right? Now we're doing part 2. When you see on the exam cash flow to revenue, you probably don't need to think of what is the equation. You're just going to think, oh my gosh, operating cash flow over net revenue. And then you just always interpret these ratios. And I think I've given you this advice before. Whatever that ratio is, just automatically put $1 in the denominator, and whatever the numerator is, say suppose this cash flow to revenue is let's say 0.2. What does that mean? Well, for every $1 of revenue, we're generating, 20 cents in cash flow. So that's how you calculate and interpret. You have your phones handy. Here we go. So here we have some coverage ratios for the right-hand side of the balance sheet. So there's the debt payment, there's the dividend payment, and so those interpretations on the right-hand side are pretty straightforward. Here's one final one, ability to meet interest coverage. We have this ratio many times before. So let's take a look at a quick example. What are we asked for down at the bottom? Let's do the debt payment ratio. So all we're going to do is first calculate those cash flow from operations. Now, in this case, we're going to start with the net income. We add depreciation, that non-cash, and then we've got to make sure that we keep our pluses and minuses together, whether we're adding or subtracting on the top left-hand or the top right-hand side of the balance sheet. So there's the numerator, 770, debt repaid, 233. So look at our little challenge down at the bottom, calculating that cash flow from operations first. So that takes us through those 2 LOSs. Lots of stuff in here, but notice that it adds tremendous value to what we did in part 1. I'm guessing that some of you have gone to the end of that learning module and have already completed those 4 questions, and I'm hoping you got all 4 of them right. At least you should have gotten 3 out of 4. And remember, if you can do 3 out of 4 on every set of 4 questions, there's no way that you're not going to pass this level 1 exam. So hey, thanks for watching, and have a great day. Good luck studying.